Good morning, good afternoon, good evening, and hello to all of you whenever you are watching this video. My dear friends, we are here for the revision of paper 3, Cost and Management Accounting, a 100 marks paper. And topic of this video is marginal costing. Now, this is one of the most important topics, not only from your inter CA point of view, but also from your final CA point of view as well. At your level, the questions which you have can be divided into certain categories. Like, first category is absorption versus marginal. That is first question itself. Then your major part is covered through break-even analysis, and then there are few questions on the indifference point concept. These are the various categories of questions at your level. Naturally, the first area is absorption versus marginal. For that, I need to go to the textbook. And here's the textbook. Now, I will directly take you to question 1. And I'll keep my discussion question based itself. Revision lecture, so we'll stick to this. When you solve this question, few points that you studied regarding absorption versus marginal, I'll repeat again. I am sticking only to the question based discussion. Under absorption costing, fixed cost is considered as a product cost, and under marginal, it is not considered as a product cost. So when you were valuing stock under absorption costing, it was valued at fixed and variable both. When you valued the stock under marginal, it was valued only at variable cost. That was the first point of this question. Second point, opening stock valuation. Now, opening stock of current year is valued at previous year's cost of production. I repeat, opening stock of current year is valued at previous year's cost of production. In this question, previous year's cost of production was not given. So what we did, we decided to use the standard data with a basic assumption in our mind that the current year's standards are reflection of previous year's actuals. And that's how we valued our opening stock. Third point that I would like to draw your attention towards in this question is that there was surely an impact of under or over absorption. I'm not going into the detail whether there was under, over, etc. Simple point I would like to remind you is that there was surely an impact of under over absorption. There were multiple treatments to treat that, and at this stage, let me inform you in blunt words, unless you revise absorption, this question you wouldn't have been able to solve. So your under or over absorption could have been carried forward, could have been treated by a supplementary rate system, or even adjusted in cost of sales. Well, I have always adjusted through supplementary rate system. In this question, there are multiple treatments existing. I always used to do, and I still do, this question using supplementary rate system. So the impact on the other items of cost sheet is clearly visible to us. But then technically you can follow any other method. And finally, when they talk about difference in profits, my dear friends, that difference in profits is nothing else but reconciliation. Whichever technique you are using for your reconciliation, you can use that and find out reasons of difference between profit as per absorption costing and profit as per marginal costing. So that was this particular question, gave you a good idea regarding the absorption versus marginal point. Now I will take you to break-even analysis basics. It's obvious, it's a revision lecture. So I will certainly, and I repeat, I will certainly now stick to formulas. I'll give you a revision of all the formulas. No worries about that point. But let's accept only formulas. And I'm sure probably that's what even you are hoping for, that we get the revision of all the formulas. Just wait for a second, I need to bring you to the fresh page. That's the fresh page right in front of us, guys. Now, let us discuss about as I said, all the formulas and all. So, sales less variable cost, that will give you contribution, less fixed cost, and that will give me net profit. This much all of us know. It's just that I somehow present it this way: sales minus variable cost is equal to contribution, which I divide in two parts. Fixed cost and net profit. Oopsie, that's the view for you. Now, guys, at this stage, what I am planning to remind you is, see, from the formula you can from this chart, should I say, you can calculate multiple formulas like sales minus variable cost is contribution. So sales is equal to variable cost plus contribution, and I mean that's a kid stuff. We all can do it, right? I would like to remind you regarding few things, namely PV ratio, break even point, margin of safety, and margin of safety ratio. But then there are few corollaries to that, so just pay attention. First and foremost, PV ratio. We call it PV ratio, it's nothing else but profit volume ratio. What is PV ratio? Simple words, percentage relation between contribution and sales. I repeat, I'm not going into the details of the formula. This is revision. I request you to stick to this. In your lectures, you would have surely done, and I really, really respect what you have done. But right now, when you are revising, just stick to this. What is it? Contribution upon sales into 100. That is PV ratio. Secondly, now guys, now I am very clear. Listen to me. PV ratio is a percentage relationship between contribution and sales. From this, one more thing which you can find out is VC to sales ratio. That is variable cost to sales ratio. How do you calculate? Normally, it should be variable cost upon sales into 100. That's how you do it. But, well, you can also do it this way. Guys, now listen. VC to sales ratio is equal to 100% minus PV ratio. In the same way, you can also calculate PV ratio this way. PV ratio is equal to 100% minus VC to sales ratio. Yes, this will help a lot while solving the problems. I am too sure about that, and I'm sure now you are even starting to remember the problems that yes, we did that. So that's why I took this up. Now I will like to go to fresh page for break-even point. One sentence logic of break-even point. It is the amount of sales at which there is no profit, no loss. Simple. It is the amount of sales at which there is no profit, no loss. That's it. So now how do you calculate? See, you can calculate break-even point in rupees also and in units also. So let us remind ourselves of both formulas. First, I'll pick up in rupees. Some questions sometimes use the words value. And in units, some questions sometimes use the words volume. So first formula, it is fixed cost upon PV ratio. It is fixed cost upon PV ratio. That will give you break-even point in rupees, and once you have break-even point in rupees, you can surely, I repeat, you can surely calculate your break-even point in units. So how do you do that? So simple. BEP in rupees divided by selling price per unit. Another way to talk about this, or to calculate BEP in units directly, what do you do? Fixed cost upon contribution per unit. Fixed cost upon contribution per unit. And once you calculate it in units, you can easily calculate it in rupees. So BEP, this is the second formula. I might give the number as well. BEP in units into selling price per unit. Now, once we are done with break-even point, I'll take you to margin of safety. Let me give the heading for margin of safety. Now, talking about margin of safety, again, it can be in terms of value, or let me just continue in the same way which I did earlier, in rupees, which some people call it as value as well. Some questions call it as value, and in units, which some people prefer to call it as units. Oops, or should I say volume? Okay, now, so what is margin of safety? Simple words, it is additional sales over and above break-even point. Technical words, I'll go slowly, listen. Amount of sales, even if by which your sales will fall, you will still not make losses. Technical words, simple words, additional sales over and above break-even point. Simple. So how do you find that out? So simple. So it will be total sales in rupees minus BEP sales in rupees. Naturally, that will give you margin of safety sales in rupees. Once this gives you margin of safety sales in rupees, you can simply calculate units. So margin of safety sales in rupees divided by selling price per unit. Other way around, how to calculate it in units directly? Simple. Total sales in units minus BEP sales in units. Naturally, this will give me the BEP sales. Once I subtract BEP sales in units from total sales, I'll get margin of safety sales in units. Once I get that margin of safety sales in units multiplied by selling price per unit. So that, my dear friends, is the margin of safety explanation. Next, I move on to margin of safety ratio. Margin of safety ratio, well, it can be calculated in units as well, but generally we prefer to calculate it in terms of rupees only. What is margin of safety ratio? It is a percentage relation between margin of safety sales and total sales. It's nothing else but percentage relation between margin of safety sales and total sales. So, margin of safety sales in rupees upon total sales in rupees into 100. Now, one corollary which we can find out from this, just pay attention. Well, technically speaking, BEP ratio also can be found out this way. BEP sales in rupees upon total sales in rupees into 100. Alternatively, you can also calculate it this way. BEP ratio is equal to 100% minus MOS ratio. Same thing, but in a little different way. MOS ratio is equal to 100% minus BEP ratio. So many things are covered by now. Now I need a fresh page to explain something special. Just a second. That's the fresh page. I call this as a summary of the whole marginal costing. This is my opinion. I'll need a red color. So, two things I would like to put in front of you. This is first, total sales in rupees into PV ratio is equal to total contribution in rupees, which I divide in two parts. BEP sales in rupees into PV ratio, and this will give me fixed cost, and MOS sales in rupees into PV ratio, this will give me net profit. And alternatively, I can get one more formula from here, from this part, that is net profit upon PV ratio is equal to MOS sales in rupees. That is what first special point which I wanted to explain. Similar thing, but in my second special point coming up right now. Similar thing. Second, total sales in units into contribution per unit. So I will just shorten this. I'll need some space. I'll use a short forms. I'll write it this way: contribution per unit is equal to total contribution in rupees, and that, my dear friends, can be divided in two parts: BEP sales in units into contribution per unit, and that will surely give me fixed cost. And finally, MOS sales in units into contribution per unit, that will give me net profit. And well, I can get one more formula from here, that is net profit upon contribution per unit is equal to MOS sales in units. So with that, guys, I have revised every possible formula. I'll now take you to the textbook to start solving the remaining questions, or should I say reminding remaining questions. Just a second. That's the textbook in front of you. Now we move on to question 2. I'll be discussing all the points. Wherever the need arises, I might solve the questions, different point. And well, taking you towards question 2, I hope you will remember it's a very simple question. It was a normal break-even point and cash break-even point. For cash break-even point, you got to calculate cash fixed cost, so you will simply subtract the depreciation. Well, as far as third question goes, I would like to solve it right in front of you so that a little help in revision can be given. The question says that the variable cost to sales ratio is 70%. The break-even point occurs at 60% of capacity sales. Find the capacity sales when the fixed costs are 90,000. Also compute profit at 75% of capacity sales. Now, to solve that, I'll need a board. Just a second. The board is right in front of you. What they say? They have said that variable cost to sales ratio is 70%. So, variable cost to sales ratio is 70%. Now, we have done this in theory. I'm sure you will remember PV ratio is equal to 100% minus VC to sales ratio. So 100% minus 70% is equal to 30%. Now, They have further said that break-even point occurs at 60% of capacity sales. So I will simply find out break-even sales. Once I'll find out break-even sales, with cross multiplication, I can find capacity sales. It's so simple. Understanding the whole topic is easy if you concentrate when the theory was being done or is being done, or whatever words that you prefer to use. Then just look at what they require and the flow automatically will come in solving. Now we are given fixed cost. We know break even point in value, that is in rupees, is fixed cost upon PV ratio. So BEP in rupees is equal to fixed cost upon PV ratio. Now, how much is fixed cost? The question clearly tells you 90,000. PV ratio is 30%, which means 0.3. So, three lakhs is your break-even sales. And you are told that break-even sales are 60% of capacity sales. So that means sales, break-even sales. If total sales are 100, break-even sales are 60. So if break-even sales are 3 lakhs, how much will be sales? That is capacity sales. That is what they call it. 5 lakhs. So capacity sales which they wanted is 5 lakhs. It's so simple. Now they want further profit at 75% of capacity sales. So what to do? Again simple. We have done this while we were revising the theory. Sales, this will be 7, or rather let me give the heading, in fact, profit at 75% capacity sales. So first and foremost, I will calculate 75% capacity sales. Your capacity sales is 5 lakhs into 75% is equal to 3 lakhs 75,000. Now we know this very well. Sales 3 lakh 75,000, variable cost is equal to contribution. Now some part of that sales we are taking. The relation which is given here at the top, which you can see, that will not change. That relation will remain same, which means variable cost will continue to be 70% of sales. So three lakh 75,000 into 70%, 262,500 is your variable cost. Your contribution will be 1,12,500. Now, which we divide into different parts. Fixed cost and net profit. Now, fixed cost is given to us at 90,000. So certainly 1,12,500 minus 90,000, that will give me profit 22,500. That's it. That's the answer. My dear friends, what I'm trying to tell you is this, that if you will revise the theory of this chapter thoroughly well, and if you will read the question well and identify what exactly is required, flow of the solution automatically will come. The biggest trouble with this chapter, if at all you call that as a trouble, I call that as an advantage, by the way, is that there is no set pattern of solution. You keep on finding few things, and when there is no set pattern of solution, to me that works as a real advantage. You can follow any pattern. That really helps. In my humble opinion, that really helps. So my dear friends, that is what was your question number 3. That's how you solve it. Again, I'll bring you back to the textbook and I'll continue with my discussion. As far as question 4 goes, in question number 4, they have given a single product company sales is 60 per unit, and margin of safety is 40%, fixed cost 360, variable cost 80%, that is variable cost to sales is 80%. Variable cost will go up by 10% and fixed cost will increase by 5%. Find the selling price required to be fixed in 2004 to earn the same PV ratio. So if you wish to keep the PV ratio same, even the variable cost to sales ratio will remain same. If you remember this, then this part will become very, very small. The solution will come very quickly, a simple cross multiplication and you will get the answer. Please, please, please remember this point. See, in this question, what is important is to understand what remains same and what changes. Here they have said that PV ratio must remain same. Naturally, that means even variable cost to sales ratio will remain same. They have given the changes, you make necessary changes, but then it will be very easy to find out selling price later due to this fact. At the same time, what I am trying to tell you is that they have asked you to change fixed cost and variable cost. Don't forget the basics here. Don't forget the basics here. Fixed cost in total will remain the same. Variable cost per unit will remain the same. I repeat that again, fixed cost in total will remain the same, variable cost per unit will remain the same, which means fixed cost is a total concept, variable cost is a per unit concept. Any changes in fixed cost should be done on total basis, and any changes in variable cost should be done on per unit basis. Don't forget this change that you are supposed to make. And at the same point of time, a friendly suggestion in such type of questions, when you calculate all the present possible details, which means sales, variable cost, contribution, fixed cost, net profit, selling price per unit, variable cost per unit, contribution per unit, number of units for that matter, then the remaining part of the solution will become easier because changes will become simpler. So in this type of questions, always follow that. Don't forget that. Now I will discuss required part 2. Required part 2 simply says that make me invisible first. No, required part 2 doesn't say make me invisible. Do arey yaar, you people. No, required part doesn't say make me invisible. Required part 2 says that same selling price of 60 per unit and profit also same. You want to find out number of units required to be produced and sold. So again, the question is still the same. What should be kept same and what should not be kept same, what should change, etc. That is what you should understand. Selling price will remain same, they want the profit same, so accordingly you got to solve this question. Please remember these type of questions well, or high chances of these being present in the paper. With that, I finish my discussion of question number 4. Now I move on to question number 5. Very easy question, just in case if you remember, they had given details for every half and you had to calculate required part. Like for example, here profit volume ratio, break-even point and margin of safety for first half. Then sales volume for the second half year. you had to calculate everything for the half and then finally for the whole year. Very simple question, except one point. The fixed cost which is given to you is for one half. Second half, they have said that fixed expenses remained unchanged during the second half year. Again, 4,50,000 will be fixed cost for the second half. Total fixed cost for the year will be 9 lakhs. That doubt always comes. I repeat, that doubt always comes. Whether it is for the year or whether it is for the half year. It is for the half year, guys. Don't forget that. It is for the half year. When you will create the whole year's data, you realize that is for the half year. This is the most common doubt here. Please be careful with that. And I finish with the discussion of question number 5. Moving on now. Yes, next is question 6, I agree. But then I want to solve question 7 once again. Some time ago I said that when you are given that this changes, that changes, you try to create every possible detail at present. I said that, right? I'll bring that up right now, and for that first I'll solve question number 7. Whoopsie. Then I'll come back to question number 6. Look at this. Automobile manufacturing company produces different models of cars. The budget in respect of model 007. Please come back to studies. Please come back to studies. Okay. 007. That's fine. That's great. We go ahead. Month of March 2005 is an budgeted output. Net realization 700 lakhs. Materials 264. Labor 52. Direct expenses and then specific fixed costs are given. Allocated fixed costs are given, and so on and so forth. Everything is given. Profit is given. Let us try to calculate the present scenario first. I'll need the board for that. I'll bring the board in front of you. Now, the board is right in front of you, my dear friends. First, they have said sales. 700 lakhs. So 700 lakhs, which will mean 700 into 1 lakh, that is 7 crores. Shall I write it on the next line so that I can calculate that per unit figure as well? And then I'll calculate per unit figures. There are 40,000 units. Don't forget that. I told you, create as many details as possible. So 7 crores divided by 40,000 per unit figure is what I'll write here, 1750 less variable costs. So in variable costs you have 3, namely material, labor and direct expenses. So first I'll write material, that is 264. So 2 crore 64 lakhs. 2 crore 64 lakhs. Again, I'll calculate per unit figure, 660. Labor, that is 52. So 52 lakhs. I'll calculate per unit figure of that as well, 130. Direct expenses, I am given as 124. 124 into 1 lakh. So that is 1 crore 24 lakhs. And again, I'll calculate per unit figure, which is 310. After that, I will calculate here total variable costs. Naturally, that will be easier for me to calculate contribution in this scenario. I'll mark that as V and I'll mark this with S. So that is 4 crore 40 lakhs, again 40,000. So 1,100 is per unit figure. That will give me contribution. And my contribution will be 7 crore minus 4 crore 40 lakhs. So 2 crores 60 lakhs. That will be my contribution. Again, per unit figure is what I want, 650. Naturally less, I will say, fixed cost. Now in fixed cost, I am given two. One is specific and second is allocated. Certainly, I'm sure you know, we need not calculate per unit figure of fixed cost. So 90 and so 90, when I say it will be 90 lakhs. And allocated. So 112.5 into 1 lakh. 1 crore 12 lakhs 50,000. Yeah. By the way, this contribution we have achieved by calculating S minus V. This is what we call C. I will calculate total fixed cost. Two crores 2 lakhs 50,000. And then finally I'll term this as FC. So I will get the net profit. Two crore 60 lakhs minus 2 crore 2 lakhs 50,000, 57 lakhs 50,000. Naturally, that is the profit which they have given in the question. That will be your NP, which is C minus FC. I have done all the present details presentation. Now, look what they want. The question says that profit with 10% increase in selling price and 10% reduction in sales volume. Wait. I want new sales. This is, of course, I'm solving required part 1. I want new sales. 10% increase in selling price. So new SPPU. See now how easy it is for us to calculate. Earlier SPPU was 1750. They say 10% increase in selling price. So 1750 plus 10%. 1750 plus 10%, 1925 per unit. And 10% reduction in sales volume. So new sales quantity. It was 40,000. I'll subtract 10% out of that. So 36,000 units. So new sales amount is equal to 36,000 units into 1925 per unit. 6 crore 93 lakhs. Now, per unit variable cost will remain same. They have not asked to change. It cannot change per unit. It will remain same. My point is different. I'm not even talking about that. My point is that if per unit variable cost is remaining same, then still total variable cost will change because quantity is changing. So new variable cost. So new variable cost 36,000 units into. Now variable cost earlier was 1100 per unit, as you can see from the calculations. So 1100 per unit is equal to 3 crore 96 lakhs. And you want profit. Well, what I would like to tell you is something simple. There will be no change in fixed cost because they haven't given. There will be no change in fixed cost. One of our vital presumptions was that fixed cost in total will not change. So sales is 6 crore 93 lakhs minus variable cost that is 3 crore 96 lakhs is equal to profit, is equal to contribution. So 2 crore 97 lakhs. From that I will subtract fixed cost, or shall I say I will bifurcate my contribution into two: fixed cost and a net profit. Fixed cost, as I just discussed, it will remain same. That will be total fixed cost, which we have already calculated, 2 crore 2 lakhs 50,000. So 94 lakhs 50,000, and that becomes your profit. Simple. Now just one point. This first required part is over. I'll go to the second required part. I don't deny that. Just one point that I would like to tell you. How sales could have been calculated differently. I repeat, how sales could have been calculated differently. What I am told, what is the change? 10% increase in selling price, 10% reduction in sales volume. So I am just doing this plainly from a concept purpose. Seven crores is your present sales, that we all know. Now there is a 10% increase in selling price, so I'll add a 10%. And then they have said that 10% reduction in selling price, in sales volume, so minus 10%. You can't act like someone who has never studied anything in the life and say plus 10 minus 10 cancel. Please don't do that. Please, for heaven's sake, don't do that. We go ahead. Please help them if they do it. Please. I don't know what to tell some people. Less 10% and you still get the same figure. So what you do is, I'll tell you, 7 crores you take on your calculator, add 10%, and then from the figure which you get on your calculator, subtract 10%. So into 10%, subtract, and you still get 6 crore 93 lakhs. That is what you got here. Now, as far as variable cost is concerned, guys, this is very, very conceptual. This is very, very conceptual. Please try to understand. Please try to understand. This is very conceptual. Please listen. For variable cost, your present total variable cost is 4 crore 40 lakhs. I am not saying that per unit cost will change, but your quantity has reduced by 10%, naturally there will be an effect on total variable cost. There will be an effect on total variable cost. Your quantity has reduced by 10%, so minus 10%. 4 crore 40 lakhs into 10%, and that you subtract, and you get 3 crore 96 lakhs. That, my dear friends, was the concept which I wanted to teach you. And second part says volume to be achieved to maintain original profit after 10% rise in material cost. So the only change that will take place here is that material cost will change. You increase that, but again per unit cost that you change, and other calculations will follow accordingly. Don't forget, you are asked original budgeted selling price per unit. Let us try to solve that as well first. So part 2, what you are told, material cost will change, so new material cost, but naturally per unit is equal to, new material cost per unit will be equal to, you are told that 10% rise, so present material cost is 660, that is present material cost. So 660 plus 10%, 726 per unit. It is 726 per unit. Now they have not given any information regarding the other variable cost, so that logically means that it will remain the same. I repeat, that logically means that it will remain the same. Now what do you want? Read the question again. You want the original profit which was there earlier, which means you want the profit of 57,50,000. That's the present profit, that is what you want. So required profit is 57,50,000. There is a no change in the fixed cost. They haven't said fixed cost can't change, so fixed cost we will keep same, which is 2 crores 2 lakhs 50,000. So now the required contribution is 2 crores 60 lakhs. I will simply find contribution for 1 unit, or in our words, contribution per unit. So how will I find? Simple. Selling price per unit which is, they wanted to keep it same. Check the question. They said at the originally budgeted selling price per unit, which is 1750. Guys, I hope you realize that since we have calculated all the possible details at present, how easy it is to solve this problem. 1750 less variable cost per unit, So as far as variable cost per unit goes, first I will write material, and well, that will be your new material cost per unit, which is 726. As I said earlier, and I repeat, there will be no changes in other variable cost per unit. So labor and direct expenses per unit, again we will have to keep same, and we have calculated that earlier, my dear friends, which is 130 and 310. So 726 plus 130 plus 310 So 1166. Contribution per unit is 584. Now it's a very simple way to solve that. 1 unit will require contribution of 584. So for 2 crore 60 lakhs, how much units should be sold? $44,520.55, approximately 44,521 units. That's it, guys. That's it. That's the problem. And the concept which we studied here, the one which I've written in the black. Now I come to 6th question. Give me a second. You are told identical things in 6th question, that next year profit is 23% on capital employed. That's okay, provided the sales volume is increased by 10%, increase in selling price by 4%, overall cost reduction 2%. Same logic, same things will be applicable here. Your units are not given, so you can actually apply the same logic. Don't forget, change in sales quantity will lead to change in total variable cost. Here there are other changes given. This problem becomes extremely simple. First you calculate present scenarios, make necessary changes, which I taught you in the 7th question, and the answer will come identical to 7th. This 6th question can be solved. That's why I solved the 7th question first. And obviously with that I finish my question number 6 and 7 together. Now we move on to question number 8. Small question, very small in fact. Company has a PV ratio of 40%. By what percentage sales must be increased to offset 20% reduction in selling price? Hidden part, to keep the contribution same. Yes, that was the hidden part here. That was a point to be understood here. The best way to solve this question will be to take an example. Take sales quantity as 100, take SPPU as 10, and solve the question. Make necessary changes. Your answer is bound to come. Don't try to solve it mathematically. It will become difficult. It may become difficult. I can't say it will, because some of you might be wonderful at that. So I respect that skill. But to make it simple for everyone, I would suggest to take an example. Repeating once again, sales quantity as 100 and the selling price per unit as a 10. That will make the things much simpler. Talking about 9th question, a very simple question, but presentation of data in a specific format will make it simpler. Yes, you heard me right. Presentation of data in specific format will make it simpler. So first you find total cost excluding commission, which is what all these costs are. To that you add commission, shall I say. You will get total cost including commission. Add profit, you get sales. Take sales as 100. Write all the percentages. I'll repeat once again. Take sales as 100. Write all the percentages. Go reverse. Then simple cross multiplications will get all the answers. But if you don't arrange it in this format, this question might give you some troubles. But then I hope by now you remember, first part was never a trouble. Second part was the real trouble. Selling price is changing. Selling price is 14 per bottle, as you can see. Selling price is changing. So what do? They have asked you to find out break-even point in value, that is in rupees, and in units. My best way, there cannot be one best way in this chapter. I mean, all of us know that by now, multiple ways. My best way, I will find out contribution per unit from somewhere. Fixed cost in total is bound to remain same, what I calculated in part 1. So if I do fixed cost upon contribution per unit, I'll get break even point in units. I'll multiply that with 14, I'll get break even sales in rupees. Simple. But how to find out contribution per unit? Selling price per unit is given 14. Other variable costs. You would have already calculated variable costs in first part. Calculate per unit. Add commission. But commission should be 8% of rupees 14. And that, my dear friends, is the most important part of this question, in my opinion. In my humble opinion, that remains the most important part of this question. Dear friends, please try to understand. Please try to understand, my dear friends. Commission should be 8% of 14 because selling price has changed. The question very clearly says that commission is 8% of the sale price. Earlier commission which you got was on the earlier selling price. So make this necessary change. Don't forget that. Moving on to question 10. Very simple question. Ignore M, start with N, but then N and O. In this question, you will have to calculate weighted average PV ratio. I repeat, in this question, you will have to calculate weighted average PV ratio. Then you will find total break-even point. Ratio of sales will also become a ratio of break-even point in units. And then you can solve this question very easily. Nothing great with this question. In fact, if you solve this question, 11th question's second part is identical to this one. The ratio is different. The ratio is 7:3. That's the only change. No change whatsoever. It's identical. But question 11's first part, which I'm doing right now, is you are given selling price of 40, variable cost is 16 per unit, you are given fixed cost. Only point, it's there in the original question as well. It says annual sales are at 60% of margin of safety. It actually should be, that MOS, margin of safety sales, are 60% of annual sales. So pretty simple way to solve this. You are given selling price per unit, you are given variable cost per unit, you can certainly calculate contribution per unit. You are given fixed cost, you divide that. You divide that fixed cost by contribution per unit, you will get break-even point in units. Multiply that with selling price, you will get break-even point in rupees. You are given margin of safety at 60%. That logically means that break-even point are 40% of sales. Cross multiplication, you will get the full sales. Reading the question, finding out what is required becomes the most important part, in my opinion, for these type of questions and for this chapter. In fact, with that I finish question number 11 as well. Now we move on to question number 12, and I'll bring that in front of you. And the moment you looked at question 12, you realized that new formula, change in profit upon change in sales into 100 was used for PV ratio. Not a great formula as such, if you still remember the logic which was done during your own lectures. 3 vital presumptions of marginal costing, which we have done right at the start in the theory, that came to play for this particular question. And then we could do that formula's calculation, change in profit upon change in sales into 100. What were 3 presumptions? SVPU remains same, VCPU remains same, fixed cost in total remains same. Once those 3 formulas are, rather once those 3 presumptions, I might say, were used, you got that formula, you got PV ratio. Once you get PV ratio, my friendly suggestion to ensure simple solving of the remaining required parts, create the present data of both years totally. I repeat, create the present data of both years totally. Like for both years, you calculate sales, variable cost, contribution, fixed cost and net profit. Naturally, when you do this, you will get fixed cost, which in both here will remain same, automatically your break-even point calculation, which is your second required part, will become easier. At the same time, profit when sales are 1,80,000 also will become clear. You take sales as 180, you have PV ratio, you will get contribution. And once you get contribution, naturally you have fixed cost, automatically you will get net profit. And the other required part says sales required to earn a net profit of 12,000. So you put 12,000 as profit, you always have fixed cost. You have contribution, go reverse, you will get sales. Guys, margin of safety we all know, sales minus break-even sales, different point. This entire problem has two basic keys to solve. One, that formula will change in profit upon change in sales into 100, and second, creation of present details for both years. If you do that, solving will become simple. Of course, you have a choice not to do that. It's your choice. I mean, people have a right to struggle. You struggle. What can I do in that? But if you really don't wish to struggle and would like to follow my suggestion, kindly do it, make it simple, and create the present data for both years. That will make things very simple. But then that's about it. Remember one more point. This is one of the most asked question ever in marginal costing. One of the most repeated question in marginal costing is this one. So if you can solve this easily, it will be wonderful. Good chances of getting good marks. But then that's about question number 12. I now move on to question number 13, 1-3. Now, in 13th question, what happens is that company sells its product at 15 per unit, you are told. If it produces and sells 8,000, there is a loss of 5 per unit. If it is selling 20,000 units, then it earns a profit of 4 per unit. So, what you do, the concept which we are going to follow in this question is same what we followed in 12th question, which means same thing, absolutely. Change in profit upon change in sales into 100 will give you PV ratio. So what do? Calculate sales for 8,000 and 20,000, calculate loss for 8,000 because you are incurring loss, and calculate profit for 20,000. Find the difference. Finding difference in sales is very easy. Finding difference in loss and profit will be difficult. The difference will be doubled. Don't forget, one of them is a loss. I repeat, don't forget, one of them is a loss. The difference will be doubled. Once you get that difference, you get PV ratio. And once again, to keep things simple, calculate present details. And if I would be you, I will calculate present details of that 20,000 units data. I will calculate all present details: sales, variable cost, contribution, fixed cost, net profit. And the moment you do that, you automatically get fixed cost. You just calculated PV ratio. The answer of this question, namely break-even point, you will get it very easily. So my dear friends, once again, the key to this question as well were same as what you have done in the previous question. That formula, change in profit upon change in sales into 100. And of course, calculating the present details. Once you do that, these questions will become very, very simple. Both questions on the same topic. Don't forget that. With that, I finish my discussion of question number 13, 1-3. Moving on to question 14. Very simple question. I don't deny that. But as always, few points. You first simply calculate contribution per unit under all three. They have asked to calculate opportunity cost. I agree. But at least first listen to me. What I'm saying. You calculate contribution per unit for all three products, which is very simple. SPPU and VCPU are given. Then you find out total contribution. Now, how to find out total contribution? You have to take lower of market demand and production capacity. Why? Lower of? Sir, we are usually used to take higher of. Arey, no Ray, you listen man. Listen. See, 3,000 is your market demand. I'm talking of product X. 3000 is your market demand, 2000 is your capacity. Even if the market is demanding 3000, you can't produce 3000 because that is not your capacity. Same way for Y. Market demand is 2000. You have a capacity to produce 3000, but why the hell will you produce 3000? You will produce only 2000. So simple. So that's why I said take the lower of market demand and production capacity, multiply, you will get total contribution per unit. And then when you calculate opportunity cost, remember one thing. Any one of the 3 products in a year. Yes. So if you produce X, you have to decide whose opportunity cost you will forego, Y's or Z's. You can't say Y's and Z's both. That's the only point in this question. That is the only point in this question. So if you produce Y, then you have to decide whose opportunity cost you will let go, X or Z's. Same will go for Z. Very small question, but this point is very critical for you to remember. Don't make a mistake regarding that point. And now I come to 15. A long question. I don't deny, quite a long question. You first have to decide how many units you can produce. Naturally, the logic which you use in part A, same logic will be used in part B. Once you find a number of units to be produced, then you are given selling price per unit. You have been given enough information to calculate variable cost per unit, which in this case will be the alloy. Alloy is nothing else but your material, and then variable overheads per machine hour. And these many hours are available. Don't forget, these many hours are available. So once you find out number of units, make my invisible ones. Once you find out number of units, then you can calculate your material cost and variable overheads in all. My point is how to find out how many number of units. Do a simple cross multiplication. For 1 unit, you require 1.6 kgs of material. How many maximum units you can produce from 13,000 kg? So what you do is something like this. For 1 unit, you require 1.6 kgs. So from 13,000 kgs, how many units you can make? 8125 units. Same thing you do it for machine A and machine B. Same thing you do it for both of them. Naturally, you will get 3 different units. Question is how to select. Technical answer. First, the technical answer. Lowest of the 3. Because a particular product requires all 3 resources. Naturally, there are 3 resources. Material, namely alloy, machine A, machine B. A product requires all 3 resources, so you can make only that product or only that number of units, should I say, which you have enough resources for producing. Now, this sounds very technical. Let me take one simple example in front of you. I'll take a board, just a second. Very simple example I'll take. Forget all the technicality part which is there in the question. Let's take an example of sandwiches. You require 3 things to make sandwiches. Wait, this is not a technical lesson on sandwiches. Please don't misunderstand. Okay, I'm just taking an example to help you how to select number of units. Please calm down. And if you're hungry, pause the video, go and eat and come back. Listen, you require three things to make sandwiches: bread, butter, and others. That salad and all, that is what I'm calling others. Now, you have enough bread for making 20 sandwiches. However, you have butter sufficient to make 15 sandwiches. Whereas others, that salad and all, from that material is available, only from that you can make 10 sandwiches. So how many sandwiches maximum you can make? Naturally 10. Because even though you have bread and butter available, you don't have salad etc. available for making more sandwiches. So you selected what? Lower of the three. Same logic. Same logic. So now you are conceptually clear why you used to select the lowest of the three. Of course, you were anyways clear at that time. This is just to remind you. So now you are logically clear why will you select the lowest of the three. Once you select lowest of the three, just a second, I'll take you back to the textbook. Once you select lowest of the three, then very easily you can calculate contribution per unit, SPPU. Then from that, variable cost per unit, three factors: alloy, that is material, machine A, machine B. You calculate very simply these three things, variable cost for these three things, then finally you get contribution. Same logic you apply for part B. Absolutely same logic. The contribution which is higher, you select that part, and naturally your answer was part A. That's a different point, but that's how you follow this solution. Something as simple. Talking about part B, I am most interested in the words unutilized machine hours. What do you mean by that? Now, don't forget that, by the way. This discussion, that is required part 2's discussion, will be for part A, because answer from required part 1 was part A. See, they have said very clearly spare part identified above, which was part A. So the question arises, I'm sure you'll understand that what do you mean by unutilized machine hours? Find out total machine hours. From that, subtract how many machine hours are utilized for producing part A's selected units. You must have selected some units. I still repeat, lowest of the three, which you did for material, machine A, machine B. Now, my point is pretty simple point, that find out total machine hours, subtract the utilized machine hours, that is one which is used, again I repeat, one which is used for making the number of units which you selected in part 1. The remaining will be unutilized machine hours, and that unutilized machine hours multiplied by 60, you will get contribution, plus you take contribution after reducing that selling price. That will be total answer of part 2. Important part, unutilized machine hours. How to calculate? Total machine hours minus utilized machine hours. That is how you calculate the contribution from unutilized machine hours. Unutilized machine hours into 60. Don't forget this, important question in my opinion. Now we move on to question 16. Graphical question. A few things to remember, that you need to draw 3 lines. 3 lines you need to plot: sales line, total cost line, and fixed cost line. I repeat, sales line, total cost line, and fixed cost line. Wherever sales line and total cost line will intersect, that point will become your break-even point. I repeat, wherever the sales line and total cost line will intersect, that point will become your break-even point. But to plot these lines, take some imaginary number of units. You are given selling price per unit, you are given variable cost per unit. So find out contribution per unit, you are also given fixed cost. Subtract that, find out net profit. And create a table, create a basic data. And then plot these sales of various units. Plot total cost of various units. Total cost is of course variable cost plus fixed cost. Plot total cost of units. Then fixed cost line naturally will be parallel to x-axis. There is no doubt about that fact. My point is that draw a proper graph. Don't forget all three lines will start with 0. That's the basic of solving any graph. I totally agree, it's more of a mathematical situation. I don't deny that. But then if it is there, we got to solve. So keep these things in mind and take some imaginary number of units. Keep the data simple. Like I always take 20,000, 40,000, 60,000, 80,000 units. You also do that. Take 1 lakh units for that matter more. Take 5 units, 5 types of units, 5 datas. It will become easier. Because you need to plot things. But guys, solve this graph properly. Don't forget that you got to draw 3 lines. In the second part, it says price is reduced. Naturally, selling price line will change. I don't deny that. But that's how you solve it. Okay. So remember this question. Practice at least once, if not more. Minimum once is what I would say for this particular question. And with that, naturally, I finished my question number 16. Now, moving on to question 17. Question 17, it introduced us the concept of indifference point. Indifference point is basically a concept where we become indifferent between selection of 2 options. I repeat, indifference point is a concept where we become indifferent between selection of 2 options based on a certain criteria. In this question, we deal with cost indifference point. Again, being a revision lecture, no doubt, I accept the fact that you would have studied logic during the classes or regular classes, should I use the words. Here, I'll directly move to the formula. Indifference point is calculated as difference in fixed cost upon difference in variable cost per unit. That's how you calculate indifference point. So, like for example, if I want to calculate indifference point between part A and part B, so your total fixed cost is 15,000. Total variable cost is 25 plus 15, 40 plus 5, 45,000. I'm just talking about A and B at present. So difference is 30,000 in fixed cost. This, I'll keep it aside so that my other calculation doesn't suffer. Variable cost here is 240 and here it's 140. So difference is 100 rupees. So 30,000 divided by 100 is equal to 300 cases. That becomes indifference point between A and B, which means if you have 300 cases at hand, you will not be bothered whether you use type A method or type B method. That is the meaning of the term indifference point over here. Now, that's how you calculate. That's the simplest way to calculate. The second part talks about 600 cases, etc. But before going to the second part, first part here talks about interpret your results. Well, the best way to interpret the results is take examples. You would have solved this question, your range would have been 300 to 800 cases. So take 3 examples, one falls below 300, other falls above 800, and the one more example falls somewhere in between. So what do? You calculate total cost, that is fixed cost plus variable cost. For 250 cases, this is an example, I repeat. 600 is my another example and 850 is my third example. So 250, 600 and 850. Basically these 3 points, you take an example, calculate total cost under all 3 options for 250, 600 and 850. and automatically you will realize which option is cheaper at 250, that is below 300, which option is cheaper between 300 and 800, and which option is cheaper above 800, or should I use the words cheapest instead of cheaper. And that, my dear friends, will be interpretation of this particular question. Take the examples, that's the best way to solve. And in the second part, when you say 600 and 850, already these examples will cover that point. So that's the best way, as I said, to solve this problem. Interpretation and the second required part as well. Very easy question. It's just that the flow of the question is important. Now, to be very honest with you, for this particular question, that is 18th question, my major criteria of attention is just one, that if you take contribution of x as x, then for y it says it is 1/5 less. So 1 minus 1 by 5, which is nothing else but 4 by 5, that is 80%, or 0.80. This will be 0.80x. I've written how do you get that 0.80 as well. So after that, the flow of the solution will be very important. The question clearly says that profit will be equal at 3000 units volume. Don't forget, your profit is contribution minus fixed cost. Do that for x and y both, and you will get the answers automatically. That's it, guys. That was the only point with this particular question I wanted to tell you. Nothing great as such. All of you would have done, practically all of you would have done this question on your own. That's it for my discussion on marginal costing, guys. That is about it. Nothing more than that, except one thing which I do as always in all the videos. I'll make you happy. Just a second. Make me invisible. Summary of entire questions, or rather all the questions, shall I say. Make me invisible. Make me invisible. There is no need to be invisible. Everything is visible, obviously. So that is about it, my dear friends. Thank you so much for your time, support, and patience. As and when you watch this video, keep on revising this entire part. Thank you very much, my dear friends.